Hello and welcome to this very special conversation. Markets have been at all-time highs, making newer highs, and the question that everybody is asking is how much more do we have to go from here? Is this bull market going to run for the next couple of months, couple of years? I'm sitting down with someone who has the reputation of being a thorough value investors. Well, you hear lots of people being called value investors, but I can tell you that I've heard it from some really top-notch investors that there are a few true blue value investors, and my guest today is one of them. Kenneth Andrade is founder of Old Bridge Capital Management, and he's my guest today. Thank you very much, Kenneth. Appreciate you joining in here. Thanks very much. So what does a value investor do in a bull market like the one we are seeing right now?
Well, you try to work harder or you don't work at all. Either of the ways. But I think the way we are positioned and the way the markets are evolving themselves, you do get opportunities once in a while to look at businesses that you traditionally ignored for various different reasons, and you will definitely get some pockets of opportunity in those segments. We've been in operation for the last 1 year, and while it's been difficult putting portfolios together in the true context of valuation, I wouldn't say it's impossible. So 1 year into putting a portfolio together, if I look back, I was a skeptic then. I'm a skeptic now in terms of where the valuations of the market are. But we continue to find small pockets of opportunity, and we're willing to put money to work there.
The fund is structured as a portfolio management PMS structure, right?
Yes.
You've got two schemes within.
That's
one
right.
is an all cap, and the other one is a thematic portfolio.
That's right.
And you stopped accepting more money.
Traditionally we try to go out and create an inventory of ideas. That also takes time.
Okay.
Marketing, distribution also takes time. And
Right.
since we are just about a year old, I have to wear multiple hats, and the team has to do the same.
Right.
So it works well in the context as it is now. And investing small sums of money is you tend to get a higher alpha, higher return, given that you're not really indexed in that nature. So that's the reason why we don't accept money at all periods of time.
But it's been a problem of plenty in terms of flows that are directed towards you.
We've been fortunate in the cycle, yes. I can say that we've
Maybe unfortunate in terms of valuations, but fortunate in terms of flows coming in.
that's the way the cycle always evolves, right?
Right. But you said you were skeptical then when you launched, you're skeptical now.
Yes.
But your returns are anything to be skeptical of. I mean, you've done very well, beaten the index in both the schemes handsomely.
That's the nature of the market also. I think traditional these smaller cap businesses have done reasonably well. The mid cap opportunity markets out there have also done reasonably well. So it's a confluence of two, and we've been able to like I said, we've been able to capture those small pockets that are available on time basis.
Talk about what is the philosophy really in terms of investing right now in a market like this? I mean, you're a value investor, but you have to adapt, I'm assuming, given the nature of the market and where we are at absolute aggregate index levels.
So in a market like this, where do you find value? You effectively find value where there's no growth. Okay, or where the industry is actually beaten up to a level where they earn lower than the cost of capital. These are also times where markets actually consolidate, or industries actually consolidate to two or three businesses in their sectors. That's a happy hunting ground for us. Okay, so low growth
businesses where there's no growth.
Low growth,
returns which are lower than the cost of capital.
In some cases, yes.
Okay.
Yeah. So these are two places that we like to go hunting for, and like I said, in the past we've been able to find some of those. Okay. And today, if I open the opportunities that are there, we still incrementally are able to find small pockets that are available. Okay, so these are so basically, as an investor, what we essentially look for is low valuations, and these are two places you usually find low valuations, and you find industries which are consolidating, and then you wait for a cyclical recovery in the business. So low valuations essentially means low price earning multiples, and price earning multiples will look upwards if there's earnings growth. So you get an earnings growth momentum and you get expanding valuations, and that's how we compound capital.
The thematic fund is essentially a rural-focused fund, rural and rural allied, etc. What's the play there? I mean, fundamentally.
So I'll take a step backwards, basically where we were in the cycle of 2016-17 when we actually put these two products at play. In 2016 and 17, if I look at the macro, in the at the corporate balance sheets, they were fairly leveraged. Okay, banks had their own problems of cleaning up the credit cycle, and there was no demand that was there on the ground. If I had to flip over and say that I had to point out one place where growth would come in, the government would have to take its balance sheet and do all the heavy lifting for the economy. If the government was to do that, we had a choice of putting money in the infrastructure side or in the social sector side. We chose the social sector. Okay. One, the sector was small. You needed incremental amount of money to stimulate it, and it also houses 70% of your total population. Now that had to do well. Okay, you necessarily had to see reasonable amount of schemes that are targeted towards this part of the world.
Sure.
And we saw that very early into the cycle, which was late 2015. That's why we went company by company to see the dynamics of the business and the state of the balance sheet that they had accumulated over the last decade. Some were good, some were terrible. Okay, and we started with the good balance sheets at that point in time. And what we got now with the transitioning of time over the year and a half is balance sheets are in much better shape than they were about a year and a half back. Okay, that's now started showing up in valuations. Now, if the growth cycle actually kicks in, I think the theory will play out.
Are we now in the rural sort of portfolio mid-cycle, according to you?
We mid-cycle as far as the corporates are concerned, because the first level of cleanup that comes through, the first level of cash flows that actually come through, they go straight to balance sheet because no one's expanding. So we've seen the industry or the balance sheet actually deleverage themselves quite significantly. It happened with sugar, it's happening with fertilizer, it happened with chemicals, now it's happening with some part of the fertilizer industry. So when balance sheets actually clean up, it gives them a lot more capacity to grow their future. Okay, you need financial capacity in the business to grow, to grow your business. And I think all these companies are creating that on the books. Also, for the last decade and a half, none of them have brought any supply into play. So the supply side favors all these traditional businesses. Valuations, one way or the other, they're all trading close to book or sometimes below book. In the metric of price to sales or market enterprise value to sales, all of them are working very favorable to me as an investor. And from a macro point of view, if I had to tie the two things in, the macro was getting more friendlier to businesses on the ground, and that's why we put it all together. So it's a very concentrated outlook into a very small part of the Indian economy, but that could be expansive because it also houses 70% of your population.
Sure, but we are mid-cycle, so there is.
So the low-hanging fruit is over.
The
low-hanging fruit is over. Okay. Now you'll have an evolution of a lot of new companies coming in, a lot of new businesses IPOing, which will be a norm. Okay, but that very traditional sense of the word, the low-hanging fruits is quite done. Some of these businesses are expensive in the traditional metrics of valuation.
The ones that you hold, I mean, even some of the ones that
the universe is very small. The universe is about 40 companies, and some of them are reasonably well priced.
If I look at your portfolio, I don't see any bank, private, public, NBFC. Why is that?
So if I put it this way, I could play the economy through the liability side, or I could put money to work on the asset side of the balance sheet. Okay, which is manufacturing services, consumers, etc. Or I could buy the financial services side of the business. Okay, I traditionally like the asset side of the business because every leverage that's created on the liability side actually transfers demand growth to any of the brick and mortar businesses that are there. So that's historically where I've been. It's not that I don't like financial services or banks at any point in time, because in my career I've owned them multiple periods of time. It's just that their valuation framework just doesn't suit mine in the point of time of putting a portfolio to place. Surely there are one or two companies out there that are that fall into the valuation framework. They are always on the radar, but they haven't made their way into the portfolios yet.
I mean, they've been compounders really, right? I mean, last couple of years. I mean, they have been the leaders in the bull market, NBFCs especially.
Sure, like I said, I've owned them. I've owned all of these companies at some point in time in my career, and they all fitted the valuation parameter when we did buy the cycle. A lot of these companies do have tailwinds as far as their businesses are concerned, and it's just that they may not just suit my valuation criteria. Okay, so they're great companies, but they're not great stocks.
Let me, instead of asking you what else do you find value in, let me ask you, where do you find absolutely no value in? Which parts of what are the other sectors you think? I mean, the financial services is one, as you're pointing out, but what else?
We've been struggling with consumers, though that part of the world is fairly close to my heart in terms of secular structural businesses.
I mean, Page Industries, for example, comes to mind as something that you identified earlier.
The entire consumption or consumer basket forms that part of it all. So a lot of these businesses do exist. The only part of that cycle is that I think consumption might be back-ended, and you're paying a lot of price upfront for back-ended growth. I think that's the only.
This is durables, staples.
I think it's across the board there.
Okay.
I might be wrong on that, but then I'm happy to look elsewhere for the time being.
Because you don't own very much of that either. I mean, in your portfolio.
Nothing. I own very few companies.
But you keep looking. I
mean, we do get opportunities. It's not that we don't get opportunities.
We're going to take a very quick break. We are in conversation with Kenneth Andrade. We're back in 2 minutes.